Good morning, everyone. Welcome to Silicon Valley M&A Insights. My name is Jeff Roach, and I'm here today with Tom Thomas from Pillsbury Law Firm. And Tom, go take a minute to talk about you and the firm.
Okay, thanks, Jeff. Happy to be here. As Jeff said, my name is Tom Thomas. I'm a partner in the corporate finance group at Pillsbury Winthrop Shaw Pittman. I'm in the Palo Alto office. And a significant part of my practice involves acquisition work, mergers, stock sales, asset sales, divestitures, joint ventures. In addition, I do all of the other things that lawyers in this neck of the woods do: financings, licensing and distribution, equity, board governance, and just general day-to-day corporate matters. In terms of acquisition work, it's across all industries, it's international, it's domestic, it's buy side and sell side. For those who aren't familiar with Pillsbury, we are a large international law firm and we have offices in major cities around the world. Tech is certainly a large part of our practice, but we actually are celebrating our 150th anniversary this year, so we've been around for quite a while, and as a result, we have a very broad range of expertise and practice specialties that go beyond tech, whether it's healthcare, financial services, restaurant and hospitality, oil and gas, agriculture, manufacturing, distribution, and many others. So we feel we're well positioned not only to work with tech companies, but the focus of our discussion today to work with companies that don't necessarily describe themselves as tech companies.
That's great. Again, I'm Jeff Roach. I'm a partner at Cyval Advisors. We're a mid-market M&A firm. We're not quite as old as Pillsbury. We've been around since 2002, done lots of deals in tech and in other sectors. We do both sell side, mostly sell side, with some buy side stuff and strategic advisory work. So anyway, Tom and I were talking one day, and he talked about Pillsbury being around for now 150 years. And that's exactly where this whole idea for this webinar came up. With living here in Silicon Valley like we do, it's all tech. We hear of tech. And we said, is there really life? And what do you do if you're not necessarily a tech company? And so I sort of floated this idea as a joke. I'm not a tech company. Does anybody still want to buy me? And I ran it past some of my partners at Cyval and some other people, and they said, this sounds like a great idea. So let's get going. We'll try and have some fun here. So the kind of things we're going to talk about, we thought we'd first talk about what the M&A process is just briefly, and go into basically who some buyers are, take a look at some different industries, and then talk about the whole deal process, what can derail a deal, what buyers want, and sort of how you can get started on this whole M&A journey. So with that, we're not going to go through this in detail. There's another webinar we put on a few months ago that you can get that from the Cyval website or the Silicon Valley M&A Insights website as well. It's posted on YouTube, talks in very explicit detail about the whole M&A process. It does have an impact on what we're talking about today, though, because when one starts off with things like you see in the bottom left-hand corner with valuations, coming up with preliminary valuations, getting ready, contacting process, coming up with the all needed letter of intent where you actually get into very detailed due diligence. These are the kind of things that are standard really across any industry and any M&A process. But as we'll see through today, that can have very big impact on your success and what you want to do. So if you're really interested in this, again, take a look at a previous webinar. It can give you some ideas about what the whole M&A journey is, right? So with that for a minute, I'm going to turn it over to Tom for a minute. Let him talk about the different kinds of buyers that one sees in this kind of M&A process.
Sure, but actually, before I do that, let me make a couple comments on the process. I'll just kind of focus on kind of the lower left portion of that chart, just to remind everyone that some of the things in the preparation area are going to be very important and position a company to have more success in the other areas as you move through the process. So, in preparation, it's extremely important for companies to get their house in order, and getting their house in order is going to result in higher valuations, lower costs, shorter time to close and lower risks of problems or breakage. Other things to kind of prepare for: making sure your directors and key stockholders are on board with the transaction, having a communication plan in place in case word leaks out, having a plan B in place in case the deal falls apart, and then finally, always don't be afraid to walk away if necessary, because deal momentum is a powerful thing, and it can be a powerful thing for good or for bad.
It's true. It's very true.
Just keep that in mind. But anyway, moving on to the types of buyers, as we say here, there are kind of two main types of buyers: strategic and financial. There's also kind of a geographic bifurcation as well between international and domestic. But strategic and financial. Let me start with financial first. That's the typical private equity types of buyers, and those buyers can fall into two categories. They can be looking for kind of an initial platform company, or they can be looking for an add-on. And just very briefly, the platform companies are generally kind of the first company that they want to buy in a particular area. It's usually a high growth company. It has strong management, controls, infrastructure, strong distribution. They're usually an industry leader, and the idea is that that's going to form the base of the business. And then the add-ons, if there are going to be any, and there may not be, tend to be more complementary to the platform company. They might be more kind of niche oriented, have a certain element they want to add to the platform. And often, but not always, they might have certain weaknesses that can be fixed by being part of a bigger platform, whether it's management, capitalization, distribution, market exposure, whatever it might be. So those are financial buyers. Strategic buyers are what you would think of in terms of generally operating businesses, corporations that are looking to buy a company for a number of different reasons. And then, as I said, kind of a subset is international versus domestic. And, those, have their own kind of unique characteristics in terms of what they're looking for in deal structure.
So with that in mind, let's take a look at the different kinds of industries, different types of industries. Here we'll get, and look at some industry insights. Now, so the question becomes, is there really a difference between a tech deal and a non-tech deal? Is one of the questions that Tom and I began to look at when preparing for the seminar. And actually, the punchline really is there are probably more similarities than there are differences. So let's take a look at one thing. Are the numbers of deals really that everything skewed towards high tech? Well, it turns out in 2017, only about a sixth of the deals that were done, the M&A deals that were done worldwide, actually came out of the tech sector. You would imagine that some of the other sectors, in terms of healthcare, materials, as you can see on the slides here, are a lot of fairly robust activity in terms of M&A kinds of things. So it's not that everything is high tech, high tech, high tech. It's really, again, as I said earlier, only about a sixth of the deals. Another way to look at this is the valuations. I mean, you read the Mercury News and all the things, you think that these companies are getting these sky-high valuations. Well, this is some information from PitchBook for the last few years that talks about the difference between essentially tech and non-tech deals. And you see the valuation, the multiples, the valuation multiples, which is the value of the enterprise divided by EBITDA, is a good measurement that people use in M&A deals. Is probably not as different as you would see, especially the last year or so. So it's perhaps a little surprising. It was a little surprising to me to actually understand and see that the differences were not as great as one might think. The other thing that makes a difference is actually the size of the deal. It turns out as the companies and the size of the deal gets bigger, the multiples again actually get larger as well. Now there's a if you'd like some more information about valuations, I found this pretty fascinating website. If you Google Mr. Demoraren's name, he's at the NY Stern School of Business. He's got a spreadsheet you can download, and you can look at your industry and where you are by essentially the multiples, again, the value of the enterprise divided by EBITDA. And he looked at nearly 40,000 companies. Now, these are not M&A deals, but it's the multiples of these companies that are actually what they're worth now as publicly traded companies. And as you look at the top 10, you can see that there's a few software categories here. And if you look at the bottom 10, it's things like you might expect, like auto parts and rubber and tires and things like that aren't necessarily high growth industries. But it's also fascinating that if you look through the 92 industry sectors, that you find things that one would consider technology stocks actually spread all throughout the range. They're not necessarily all at the top. So if you're interested in where you sit with your company in terms of the sector, go to the website, download the spreadsheet, and take a look at it. I think you'll find some interesting things. So what is it that drives value? Well, one of the reasons that people like to invest in tech stocks is because of what they think is the growth potential of the industry. I mean, tech has really driven a lot of economic growth over the last decade or two. And look at the growth of the industry and also how the potential of where that company sits in an industry. The size of the business, as we saw earlier, can make a difference. The size of the EBITDA, I mean, it turns out that when we at SciVal talk to potential acquirers of our client companies, one of the things that the first questions they'll ask is, are they profitable? What's the EBITDA? What's the economic side part of the business? It also turns out that one of the reasons that people like to invest in a lot of software companies and internet companies is that the working capital and capital expenditure requirements really aren't as big as trying to build a plant like a Tesla, or get into sort of more traditional manufacturing kinds of things. And needless to say, the recent macroeconomic climate has also helped. I mean, it turns out it's a very ripe time now to consider doing an M&A transaction either on the sell side or the buy side. Now, so it turns out that there are people out there that do like to buy tech, non-tech businesses. The key here, and this insight comes from one of my, Virginia Turson, of one of my partners here at SciVal, is that she uncovered this whole idea that one of the keys to being desirable is to be a value player in your market. I mean, are you a thought leader? Are you the one who's calling the shots in the particular market? How are you innovating? How are your products different? What's going on? And all the traditional performance metrics that perhaps all of us learned at MBA school, really still do apply to really any kind of industry. So let's take a look at a few of those industries, perhaps. Now, I'm not going to go through these lists of kind of things that people who are looking at acquiring a manufacturing company might like. You can scan that probably quicker than I can talk about it. But I mean, what people really, when they're looking at buying a manufacturing company, is said really here really well. It's what kind of innovation are people actually looking at? What kind of workforce do they have? I mean, I sort of joked one time that I thought it was absurd that Tesla was valued more than General Motors, but perhaps what people are looking at is the kind of thing that maybe Tesla brings to the auto manufacturing marketplace that perhaps a more traditional car company can't do. So things like the operation, how it goes, how things go, make a huge deal in terms of what's going on. And so, if I look at perhaps one of the recent M&A deal, there's a company called Sonaca, S-O-N-A-C-A, that's in Belgium that we uncovered. And they recently purchased a company called LMI in St. Louis. And the things that are on the slide are a perfect example of why this deal happened. I mean, it was a company that specializes in building parts and pieces of for aerospace. And this Belgian company acquired LMI for about $200 million. But there was another thing going on here. It actually says in the press releases around this acquisition that one of the reasons Sonica wanted to acquire LMI was to extend its operations in the U.S. So it goes back to what Tom was saying in terms of an international buyer trying to gain access to the U.S. marketplace. And we also found this particular piece of information about some multiples, both in terms of revenue and EBITDA for the manufacturing marketplace. And again, it's a little bit like the earlier multiples that we saw. And, there are deals happening in terms of, and they're not insignificant, they're not small deals. So the good news here is that there is a market here for some manufacturing companies. If I look at retail, what's going on there? Well, why did Amazon buy Whole Foods? Great example of product differentiation, product quality. I mean, Whole Foods is a textbook case in terms of being a well-run company in the retail business and how they basically provide a positive customer experience and things like that. Some other things happened. I mean, Petco bought a company called PupBox because PupBox was actually selling pet supplies and things like that online. And Petco wanted this as a way to make sure they had a really great online presence. So that's perhaps another reason that a non-tech company with sort of a tech influence, part of their business model became valuable. And that's another way to be able to look at what you can do. Is there some technology embedded in your company, even though you're not a tech company, that actually says, I'm going to make what's going on valuable? Consumer packaged goods is another way to look at it. I mean, I don't know how many of you've got one of the Ring doorbells on your house now. I do. And it's an example of Amazon requiring, Ring for about $1 billion. It's a good way to look at, here's a way that Amazon's trying to increase its presence in the house. It's looking, trying to look at, and Ring was definitely looked at as being an innovator. The idea of being able to try and look at, what's going on your front porch with when you're not at home was evidently appealing to a lot of people, I think. General Mills bought a company called Blue Buffalo Pet Products. Again, what they were looking for there is very much a lot of top line growth, but they were also looking to gain customers in a particular market segment that they may not have had before. Services companies are interesting because one of the issues with a lot of services companies is that the IP and things like that is the people. And so services companies sometimes represent a real challenge to try and acquire. So one of the things that people to have and make services companies valuable are, do they actually understand the client's business needs? Do they actually deliver consistent quality? Do they have a good brand? Do they communicate effectively? The big thing about services businesses is that can they scale without necessarily having people? What are different kinds of ways that, again, they can use technology and things like that.
So Jeff, I think that's an important point to kind of really drive home. What is a technology company? And there is no definition of a technology company, and there are a lot of companies out there that maybe don't consider themselves, quote, technology companies, unquote, as you said, but have technology. They might have a particular, they might have intellectual property that's very valuable. They might have a manufacturing process or technique that's very valuable. They might have, some other, they have some kind of an online distribution capability that's valuable. I think companies need to look at themselves as, what value do we bring to potential buyers, and that might include some technology aspects to what they bring to the table. So, from a legal standpoint, I guess to your earlier point, we don't really see a huge difference in acquiring a quote unquote technology company
Yeah.
versus any other company. Many of the same issues are the same. The deal structures, are tend to be the same. It's it's a merger. It might be a direct or a triangular merger. It might be a stock purchase. It could be an asset purchase. It could be a joint venture. What's the consideration? These days, it's almost always cash, whether it's tech or non-tech. So, they're probably the biggest difference between a tech company M&A and non-tech company M&A would be the ownership structure. I mean, at the end
That's
of the
true.
day,
That's true.
it's are there significant outside investors, whether it's venture capitalists or someone else? Do the employees have large equity positions, stock options, or some other equity? Because that is probably the biggest differentiator for deal structure when you're looking at different kinds of companies. Are do we have VCs on the board who can help leverage the negotiations and the need to have certain needs on distribution of proceeds? Do we have to deal with stock options that we need to cash out or assume? So I really think it's looking at each company in terms of the value they add to a buyer, which could cut across a lot of different categories.
Yeah. So, oops, didn't want to do that. So let's look at really what we've been talking about. Why do people really want to buy and sell a company? I mean, a buyer's looking for things like, is there a way that they can increase their capabilities? I mean, it was talking about a tech company, it was sort of I don't call it, maybe it's a rumor, myth, or truism, but the idea that Cisco over years bought a lot of companies because they were basically outsourcing their research and development efforts. And we've all heard that here in the Valley. So the idea is there a way to increase the capability, perhaps, that can't be grown in-house. The other thing is to look at maybe diversifying the product portfolio, getting into new markets, reducing cost. If you put two companies together that are very similar in terms of structure and products and things like that, then, people always look for cost reduction opportunities. The thing that is so critical today, perhaps will become more critical in the near future, is this whole idea of, making sure that you've got a good supply chain, that you've got the right kind of purchasing power. I mean, the people who are experts at things like managing purchasing power, the retailers like Walmart and Target and things like that. Tom brought this up that actually is interesting. So a lot of times a privately held company can't decide on a succession plan. And so that all of a sudden perhaps trying to sell the company actually is a good way for somebody who owns a company to be able to make sure that the company survives past the fact that
I think that goes to one of the distinguishing characteristics that we were describing, which is the outside ownership.
Yeah.
You may be more, inclined to see family ownership or closely held ownership in kind of what we consider traditional tech companies. And so, as you say, succession solutions become important when the original owner and operator of the business is 75 or 80 or whenever they want to kind of slow down and retire. So that's.
I have to wait till 80 to slow down and retire. Oh no,
we all do. Estate planning, is part of that. So I think that can be a very important driver.
Yeah, and an obvious reason for wanting to acquire a company is to take out the competition. Is if somebody's beating you up in the marketplace, buy them and make sure they're not a headache anymore. And a place that you don't really ever want to be in is trying to sell a company as a fire sale. You don't want to get into an M&A situation where you've got to do that or you can't survive. Potential buyers will know that. They'll sniff it and they'll take advantage of it in a minute. I think Tom and I both seen that. So what do buyers want? This is a list that I was going to say in roughly in order. I mean, the buyers that we talk about, that we deal with here at SciVal, you want growth, they want revenue, they want customers, they want active sales channels, direct and indirect, and things like that. It's not, and and people important too. It's not just I developed this great piece of technology, therefore somebody's going to give me $1 zillion for it. And that is if you're building a company, you've got a company. Just having just the technology sometimes works, but most of the time it's what buyers want is they really want to see a list of all of these things.
No, that's exactly right. I think whether it's a financial buyer or a strategic buyer, they all want the same thing. They might have a slightly different focus. They might have a slightly different reason, but they're all looking for those kinds of things. And again, for a financial buyer that's buying a platform company, they might be looking for something slightly different than if they're looking to add on to that. But at the end of the day, they're looking for what they need to grow the business and create the greatest value for that entity.
So Tom is an expert in sort of helping people not getting trouble. Yeah, derailing. No, to keeping the deal on the rails. So I'm gonna let him talk about that for a minute.
Sure. So we've got a list here which you can read. I'll maybe just highlight a few of those, and I'm just going to revert back to one of my early comments, which is failing to get your house in order. Can be a very important factor in whether the deal is successful or not, because you don't want surprises. You don't want to be airing your dirty laundry during the course of the deal. You want to have things lined up. It gives buyers confidence and just makes for a much smoother process. The other key point I would make is, and this is one that often companies don't focus on, and that is you really need to focus on the key deal points early in the process. And by early, I mean before you sign a letter of intent, because a seller's greatest leverage exists before you sign the letter of intent. Once the letter of intent is signed, the leverage of the seller goes down dramatically and continues to go down dramatically. And oftentimes the mistake they make is they try to keep the advisors out of the deal until they have a letter of intent, thinking that will help them save money at the end of the day, when in fact it does the exact opposite. Because a buyer should want as robust a letter of intent as possible. I'm sorry, sellers want as robust a letter of intent as possible. Buyers want as skinny a letter of intent as possible.
Absolutely.
And don't fall for the old ploy of the buyer telling you they'll deal with it in a definitive document. They will deal with it, but it won't be probably the way you would want it dealt with. So don't be afraid to involve the lawyers or the bankers or the advisors at the letter of intent stage. Get all of the things in there that you can on not just price and terms, but earn out, purchase price allocation, indemnification, escrow, all those things you hate to hear your lawyer talk about. If you can get them in the letter of intent, you're in a much better position to finish the deal on terms that you'll be happy with.
So with that in mind, what do you want to do? Well, Tom just talked about part of that. You get good help. I mean, this is one of those things where you don't want to try this at home. I use this analogy often. I said, nobody really wants to try and attempt to sell their house by themselves. You always hire a realtor. You get good advice. You get a title company. You get all those people around you to make sure that the deal goes through, because for most of us, it's the largest investment we'll ever make. And so the same thing applies here. Find good M&A advisors, get good legal help, make sure you've got good accounting help, good financial planners. I mean, all of a sudden, if somebody's going to come along and buy your company and dump a lot of money in your lap, you need to be equipped to deal with that.
Yeah, estate and tax planning is very important for companies that, like I said earlier, are typically family-owned, closely owned, and not involving those people until later in the process can be a big mistake. But as Jeff said, I mean, get the advisors involved early. It will end up saving you money. It'll end up getting you a better deal. Get things like a strong NDA in place when you're starting out. And as I've reiterated many times, get your house in order, and have plans for the due diligence process, frankly, which is a painful, lengthy process.
Yeah, no kidding.
And it may if you're selling to a competitor, it can be very very sensitive as to what information they get and when. So having a plan on how the information is going to be shared, and there are techniques you can use to help protect yourself, and then keeping the deal confidential. If employees see all these strange people walking around the building every day, they're going to know that something is going on. So keeping the confidentiality limited, or keeping the deal information limited to a small group, and doing things like having off-site diligence and negotiations, those are all important.
So with that in mind, we're at the end of our journey here, and it goes back to the idea that there's no such thing as an M&A event. I mean, it really is a journey to get ready, make sure it happens, go through the different steps, make sure you've got a good, strong LOI, as Tom just said, make sure that you've got the right kind of help. International is important. Make sure you prepare up front. Build your team both externally and internally, and it comes down to the point that, if you aren't a tech company, people do love you and they want to buy you. So any closing comments?
No, I would agree. As I said, I don't think of tech companies and non-tech companies. I think in today's world, all companies have technology. And so, I would say there are, if you're looking to sell your company and your company has strong performance and value, there are going to be plenty of buyers who are going to be interested in buying your company. So the fact that you might be in Silicon Valley, doesn't change that.
Yeah, agreed. So if you've got any questions, we've got a couple of minutes left for questions. There's a Q&A box on your Zoom panel. If not, we'll sign off. There's my contact information, Tom's contact information. You can find us through our websites at SciVal Advisors or PillsburyLaw.com. And we must have done a great job answering everybody's question. Every question anybody would ever want to know in the entire universe, we answered in 30 minutes. How's that?
That's impressive.
So we're going to sign off now, and we'd like to thank you all for coming to the webinar, and hopefully we will talk to you and see you again soon.
Thanks, Jeff.
Thank you.